Okay, good morning, my dear future chartered accountants. This is CA Chinmaya Hegde, your learning partner for CFNL, FR, and SFN. I hope my voice is audible and the PPT is visible. Okay, so we are doing FR upgradation classes. This is not a substitute for regular or crash course class. This is an effort only for solving updated problems. The material for this is available in the Telegram channel. Please make sure you download the material before attending these sessions. So let us continue today with Ind AS 103. Okay, so let us do this problem. Sita Limited and Beta Limited decides to combine together a formal dual listed corporation DLC. As per the shareholders agreement, both the parties will retain original listing board of DLC. As per the shareholders agreement, they both the parties will retain their original listing, and the board of DLC will be comprised of 10 members, out of which 6 members will be of Sita Limited and remaining 4 members will be of Beta Limited. The fair value of Sita Limited is 100 crores. Fair value of Beta Limited is 80 crores. The fair value of net identifiable assets of Beta Limited is 70 crores. Assume non-controlling interest to be measured at fair value. You require to determine goodwill to be recognized on acquisition. Okay, so first let me show you the facts of the case. So you are having one company, Sita Limited, other company, Beta Limited, and they are forming a dual listed corporation. They came together for a company called as Dual Listed Corporation DLC. And DLC will comprise of 10 members, out of which 6 members will come from Sita Limited and 4 members will come from Beta Limited. The fair value of Sita Limited is 100 crores, that is Sita Limited, and fair value of Beta Limited is 80 crores. The fair value of net identifiable assets of Beta Limited is 70 crores. Okay, 70 crores is the net assets. Assuming NCI to be fair value, you have to compute the goodwill. Okay, now even though the two company S and B have formed DLC, DLC is the new company which is being formed. They should not be called as acquirer. They are legal acquirer, but they are not accounting acquirer. What does Ind AS 103 will tell you? Ind AS 103, okay, 70 crores for beta, fine. Okay, 70 crore is for beta, fine. 70 crores is for beta. Okay. Now, what does Index 103 will tell you? There has to be an acquirer. A new company cannot be a acquirer. A newborn baby cannot be an acquirer. So what you have to decide is, in the merged company, the company which is being formed, who has the control over the another. That person has the control, or deemed that person will become deemed to be the acquirer. Legal acquirer may be different, but that person becomes the accounting acquirer. So in this case, who will be said to have the control? As you can see in the board of directors, 6 members will be from Sita Limited and 4 members will be from Beta Limited. Therefore, 6 members out of 10 is said to be the majority. So we can reasonably conclude that Sita Limited will be having the control. So Sita Limited will be having the control means they will become the acquirer, not the legal acquirer, but the accounting acquirer. Okay, so accounting acquirer we have uh, calculated. Okay, accounting acquirer we have identified, and now we have to identify from the accounting acquirer point of view. We have to calculate goodwill. Goodwill is just the difference between two things, and that is whatever consideration paid. I will say purchase consideration minus the fair value of net assets, net identifiable asset, fair value of net assets. What is the purchase consideration? They have given a fair value of Beta Limited is 80 crores. So purchase consideration becomes 80 crores. And what is the net identifiable asset fair value? 70 crores. So 80 minus 70 will be at 10 crores. That's all. And one point to be kept in mind. Okay, this is what is called as goodwill. Now, one point to be kept in mind, the fair value of Sita Limited is 100 crores, but he is the acquirer. Sita Limited is the acquirer. So, Sita Limited, you cannot continue with fair value. Sita Limited, when you show it in DLC, you will be showing at book value, because accounting acquirers will be having at book value, acquiree will be taken over at fair values. But anyway, that information is not given and not relevant also. So goodwill only be with respect to what is being taken over. So Beta Limited is taken over. That is fair value is 80 crores and net identifiable asset is 70 crores. So difference that becomes 10 crore is the goodwill. Hope you got it. Next. How will the financial statements of prior period be restated under common control in the following scenarios? Common control. You know what is the meaning of common control? This is a specific thing available in Ind AS, not available in IFRS. You can say carve out. When an entity, when there is a transfer, but the control is not transferred. So entity under one management, when it is transferred to new company, still under same management ultimately. Ultimate controller being an entity or a person remaining same, and that we call it as entity under common control. Entity under common control, the accounting aspect of business combination is it will not be taken over at fair value and goodwill or capital reserve will not be recognized. That is the essence of common control transaction. Let's see what happens here. Common control period exceeds beyond the start of the comparative period. Let's see what is that. XYZ Limited acquired PQR Limited in a common control transaction on 1st October 2009. X9, that is general, let's say 2009. The year end of XYZ Limited is 31st of March. Both XYZ and PQR have been controlled by shareholders since incorporation. Common control period started in the comparative period, started in the comparative period. ABS Limited acquired DF Limited in a common control transaction on 1st October 2009. The year end of ABC is 31st of March. Both ABC and DEF controlled by shareholder A. A made an investment of ABC in 2010 and made an investment of DEF Limited on 1st October 2008. So basically, the date of acquisition is same and date of acquisition is different. Did you get the basic point? In the first situation and in the second situation, what is the main difference? In the first situation, the common shareholder have acquired since their incorporation. So since the beginning. Whereas in the second situation, the common shareholder, the person having ultimate control, shareholder A here, in ABC he is purchased in 2010, whereas in DF he purchased in 2008. So two different dates, how it is going to be reported. Let's see what does the standard says. Maybe this particular thing I may not have covered in my theory also, but it's more of a theory question. A question is there in the study material, so we'll just try to answer it. We'll read it, then I'll explain it. Para 9.3 of Appendix C to Ind AS 103 states that financial information in the financial statements in respect of prior periods should be restated as if the business combination had occurred from the beginning of the preceding period in the financial statements, irrespective of the actual date of combination. Which means when you are preparing the business combination of financial statements, suppose you are preparing on 31st of March, in this example 2009 you acquired, so you prepare on 2010, then you give a comparative of 31/3/2009, right? And what is the current period? 31/3/2010. What is the preceding period? 31/3/2009. And what is the beginning of preceding period? 1/4/2008. Hope you get the point. So what does this point tell you? When you're preparing the financial statements on 31st March 2010, you have to restate all the financial information as if it is done or information is available from the preceding, from the uh, beginning of preceding period. Preceding period is 31/3/2009 and preceding period is 31/2009. Beginning of that means 1/4/2008. So irrespective of the fact that business combination took place this year, you have to account as if everything was there from the 2 years back, 1/4/2008. And that's what this point says. However, if the business combination had occurred after the date, the prior period information shall be restated by that date. So in accordance with paragraph 9.3 above, entity will be required to state the financial statements as if the business combination had occurred from the beginning of preceding period in the financial statements. Accordingly, in the present case, in case A, XYZ Limited will have to restate its comparative for the financial year 2008-9 as if, see 2008-9, you have acquired in the year 1st April 2000, 1st October 2009. So going back, 2008-9 is the comparative period as if it had occurred before 1/4/2008. You see the date I mentioned, 1/4/2008. Additionally, results of the current year will be required to include XYZ financial statements for the period from April 9 to September 9. So when you include for the current year P&L account, it includes the acquirer's P&L account as well. Okay, that is straightforward. Hope you got it. Second point, in accordance with para 9 above, ABC Limited will have to restate its comparative for the financial 8-9 as if acquisition had occurred on 1st October 2008. for October 2008, but not earlier. Additionally, the result of the current year of DF Limited will be required to include the financial statements of ABC Limited for the period from April 9 to 1st of October 2009. So basically, if the business combination occurred after that date, then that date means what? You can see you have acquired in a common transaction on 1st October 2009, but when the shareholder acquired the shares, shareholder have acquired after that date. After which date? After 1st October 2009. When did he acquired? He acquired in ABC Limited in 2010. So basically, after acquisition, a common shareholder has acquired the share to define it as common control transaction. Since the shares have been acquired after that date, it is going to be from that date, not the beginning of preceding period. It is from that date, which is 1st October 2008. Basically, 1 year backward transaction. I mean, so 1 year transaction. The date on which you have acquired the shares, you have acquired the shares on 1st October 2008. So from that date, business combination shall be made effective. Hope you got it. Let's go further. Next one. Entity A owns 100% of equity shares of entity B since 1/4/2001. Entity A arranges loan from financial institutions from a newly owned subsidiary called as entity C. Okay, let's try to write down what is what happened till here. Uh, entity A owns 100% of equity shares of entity B. So entity A and entity B owns 100% of equity shares. Entity A arranges a loan funding from financial institution, arranges a loan from financial institution in a newly held subsidiary called as entity C. Okay, so they have one more new entity C, uh, which is a wholly owned subsidiary. That means that is also 100%. The loan is used by entity C to acquire 100% of shareholding in entity B. So now entity C will acquire entity B 100%. Will acquire 100% for a consideration of 2 lakh. Entity A applies Ind AS 103 to account for common control transaction. Entity C will adopt the same policy. Fair value of net identifiable asset is 1,50,000. Carrying value of net identifiable asset is 1 lakh. How entity C will apply accounting in its financial statements. So you can see earlier, entity B was earlier under entity A. Now entity B will be under entity C, and under whom entity C is there? Entity C is under entity A only. Understand, right? Earlier entity A was controlling entity B. So you are under entity A. Now later, after acquisition, entity A will control entity C, and entity C will control entity B. So effectively it means you are still under the control of entity A ultimately, ultimate controller. So this is a typical case of entity under common control. And you know, in entity under common control, goodwill and all should not be recognized by the entity A. Let's see what the solution says. You know the facts already. As per para 2 of the appendix C of Ind AS 103, in the exam you don't have to mention like this para 2 and all. You just mention Ind AS 103 is sufficient. Common control business combination means a business combination involving entities or business in which all combining entities or business are ultimately controlled by the same party or parties both before and after business combination, and the control is not transitory. In the above scenario, entity A controls the entity B before and after the acquisition, and after acquisition, entity controls entity B through entity C. That is, A controls C, C controls B. As per the para 8 of appendix C of Index 103, business combinations involving entities or business under common control shall be accounted using pooling of interest method. What is pool? You should use this technical term for sure. Pooling of interest method. So pooling of interest method means when one entity acquires another entity, we will take everything at book value, including the reserves and surplus. Remember, we had amalgamation in the nature of merger in AS 14. You would have learned at intermediate levels. That concept, that principle is applied here. No goodwill is recognized. As per para 9 1 of appendix C, the pooling of interest method is considered to involve the assets and liabilities of combined entities are reflected at their carrying amounts. That means at their carrying amounts and not fair values. And goodwill will not arise. And reserves and surplus are also taken over. Based on the above analysis, entity C cannot be the acquirer. Entity A created entity C and is the seller. Entity C has effectively been formed and issued the shares to affect the business combination. Entity C is not a business, and the transaction between B and C is not a business combination. It is reorganization of entity B. As a result, entity B's assets and liabilities will be included in entity C consolidated statements at their pre-combination carrying amounts without a fair value uplift. So much we have read. Ultimate point is what? In entities under business combination transfers, accounting will not happen at fair value, it will happen at book value. As a result, the goodwill is not recognized. That's all they want to tell. Anyway, we have read it. Let's go further. Entity A and Entity B provide construction services in India. Entity A is owned by a group of individuals, none of whom has control and does not have a collective control agreement. Entity B is owned by an individual Mr. Ram. Owners of entities of A and B have decided to combine their business. The consideration will be settled in the shares of entity B. Entity B issues new shares amounting to 40% of the issued capital to controlling shareholder Mr. Ram. Mr. Ram then transfers the shares to owners of the entity A in exchange of their interest in entity A. At this point, Mr. Ram controls both entities A and B, owning 100% of entity A and 71.42% of entity B. Mr. Ram had a controlling interest in both A and B before and after the contribution. Is the business combination A and B a combination of entities under common control? So please read once more. No. Okay. So what really happened? I would like to present it once more. Okay. So entity A and entity B, two entities are there. A is owned by group of individuals. So entity A owned by many groups, many individuals, and entity B is owned by single individual, Mr. Ram. Okay, entity B is owned by single person, Mr. Ram. They decide to combine. The consideration will be settled in the shares of entity B. Okay, so basically they are going to combine, but entity B is going to issue the shares. Okay, so they are going to combine entity B. Entity B will continue. So basically, I can say entity B will be the acquirer. The consideration will be settled in shares of entity B. Entity B issues new shares amounting to 40% of the share capital to controlling shareholder Mr. Ram. No, new shares. Okay, so entity B issues new shares to Mr. Ram. Mr. Ram then transfer the shares into owners of entity A in exchange of their interest at entity A. So Mr. Ram, once he get the new shares, then he will transfer it to the many individuals. He transfers in the proportion of their interest. At this point, Mr. Ram controls both the entities A and B, owning 100% of entity A and 71.42% of entity B. Now, at this point in time, if you look at it, Mr. Ram is having the shares of entity B and is having the shares of entity A, because Mr. Ram is having the shares, everything what is supposed to be issued to entity A. Is the combination under business combination? Is it under entities under common control? Okay, now this will fit into a typical situation called as what is called transitory situation. Transitory means this is a temporary arrangement. The fact is that Mr. Ram owns entity A and entity B should not be considered as entities under common control. It's a stopgap arrangement. It's a temporary arrangement. Instead of issuing the shares directly to the individuals, it is first issued to the Ram and then Ram issued to the many individuals. So you should not say that Mr. Ram controls A also, Mr. Ram controls B also. So A and B coming together means it is under common control. You should not say like that, because the fact of transferring the shares to A, transferring the shares to Ram, this part is transitory. It's only a stopgap arrangement, temporary arrangement. And in substance, he really don't own the company. Legally at this point in time, yes, he does own the company, but the objective of owning the share is more of convenience or other legal requirements, not the substance to control the company. So we say that this transfer is a transitory transfer, or Mr. Ram holds the share in the transitory format and not in the controlling interest. And therefore, Mr. Ram will not be considered as the controller. Entity B is the controller, acquirer. Entity A will be the acquiree. That's what this sentence also will tell. This is not a business combination when it is under common control. Mr. Ram's control of both entities before business combination was transitory. The substance of the transaction is that entity B has obtained the control of entity A. Entity B accounts for this transaction as business combination under Ind AS 103 using acquisition accounting. That's your regular accounting. Okay, so hope you got it. Let's go further. On 1st April 2001, Alpha Limited acquires 80% of interest in Beta Limited in a cash exchange for rupees 300. Due to legal compulsion, Beta Private Limited had to dispose of their investment by a specified date. Therefore, they did not have sufficient time to market Beta Private Limited to multiple potential buyers. The management of Alpha Limited initially measures separately recognizable, identifiable assets acquired and the liabilities assumed on the date of acquisition date in accordance with requirements of Ind AS 103. The identifiable assets are measured rupees 500 and the liabilities assumed are measured rupees 100. Alpha Limited engages on independent consultant who determined that the fair value of 20% non-controlling interest is rupees 84. Alpha Limited reviewed its procedures used to identify the measures, the assets acquired in liabilities assumed, and to measure the fair value of both non-controlling interest in Beta Limited, Beta Private Limited, and the consideration transfer. After the review, it is decided that the procedures and resulting measures were appropriate. Calculate the gain or loss on acquisition of Beta Private Limited and also show the journal entry for accounting that acquisition. Also calculate the value of non-controlling interest on the basis of proportional interest method if alternatively applied. Okay, it's actually a straightforward question. Nothing much complications are there, but anyway. So they said you can follow proportionate method, fair value method. I hope you know this. We have discussed this during consolidation, the concept of fair value method, proportionate method. I'll just quickly go for the solution part. So one method is fair value method and the other method is proportionate method. Fair value method and proportionate method. What will be the calculation steps? We will be doing whatever purchase consideration, or we'll say the investment value, consideration paid or consideration transferred, consideration paid or transferred, purchase consideration, plus non-controlling interest. Consideration transferred will be in this case for 80% because you have acquired 80%. Remaining people, what you have not acquired, that is called as non-controlling interest, minus fair value of identifiable asset, fair value of net identifiable assets, which is the entire 100%. So basically, this is like a book value, this is like a fair value, and that's how difference we'll call it as goodwill. And how the difference between two methods will come? When you follow fair value method, NCI is at fair value. Whereas when you value and proportionate method, NCI will be at proportionate value, a percentage of net assets. Fair value of net assets. That's why it's called as proportionate method. So difference is arising due to valuation of non-controlling interest. So in this case, what are the values? You have paid in exchange for cash 300. Okay, so you have paid rupees 300 under both the methods. Fair value of 20% non-controlling interest is 84. So fair value is 84. And net identifiable assets, assets they said 500, liabilities they said 100. So net assets. So 500 minus 100, that is 400. So how much you get? 300 plus 84 minus 100, minus 400. I think you get minus 60. And in the second case, how much you get? This will continue to be 400, and of this 400 we take a percentage, and non-controlling interest percentage 20%. So 400 into 20%, which is 80. So 300 plus 80 minus 400, that is 20, right? Okay, 20. And this is negative, which means you have not, you cannot call it as goodwill, it's called as gain on bargain purchase, in the sense it is consideration which is less. What you acquired is more, what you paid is less. You acquired worth 400, but effectively you paid worth only 384, and in this case 380. Since you paid less, you got more. We used to call as capital reserve, and here it is called as gain on bargain purchase. 16 here, 20 here. This is not a common phenomenon, because why will any company sell below its fair value? That is why the standard says if there is a situation of gain on bargain purchase, the process followed should be reviewed, because there might be some asset which is missed, or there might be some missing values, something like that. And that is why they said they reviewed the procedures. This is just a additional confirmation that after identifying the gain on bargain purchase, they have reviewed the procedure and still found it to be correct. So we can go ahead and say it is gain on bargain purchase. Okay. So they also have journal entry. Okay, journal entry is straightforward. So journal entry, again I'll do it in a columnar format. Journal entry in the books of acquirer, in consolidated books of acquirer. Two methods, I'll do it in a columnar format. Fair value method and proportionate method. Okay, so what is going to be debited? Whatever the assets acquired, or I think I can write assets and liabilities separately. That is identifiable assets to liabilities. This is net asset acquired. What is coming in? What is paid out? To cash. A liability is being created to NCI. And then capital reserve. We don't say capital reserve, we say GBP, gain on bargain purchase. If it was a goodwill, that would have been debited. So let's write the amounts. Identifiable asset was 500, liabilities was 100, cash paid 300, NCI, fair value method, fair value of NCI is 84, and gain on bargain purchase happened to be 16. I think total will match up. 484 plus 16, 500, yes. Proportionate method, asset is 500 only, that remains same. Liabilities will be 100, cash will be 300, NCI will change to proportionate method. 4 into 80, 20% is 80, and therefore this sale is 20. So only these two value will change, NCI and bargain purchase, that is NCI and goodwill in some other cases. That's all the journal entry. You don't pass like this in exam, you please pass two separate entries. Okay, next. As a part of business expansion strategy, KK Limited is in the process of setting up pharma intermediate business, which is at very initial stage. For this purpose, KK Limited has acquired on 1st April 2001 100% shares in ABR Limited that manufactures pharma intermediates. The purchase consideration for the same was by way of share exchange valued at 35 crores. The fair value of ABR Limited's net asset was 15 crores but does not include a patent owned by ABR Limited for an established successful intermediate drug that has remaining life of 8 years. A consultant has estimated the value of patent to be 10 crores. However, the outcome of clinical trials for the same were awaited. If the trials are successful, the value of drug would fetch the estimated 15 crores. ABR has developed and patented a new drug which has been approved for clinical use. The cost of developing the drug was 12 crores. Based on early assessment of its sales success, the valuer has estimated its market value at 20 crores. ABR's manufacturing facilities received a favorable inspection by a government department. As a result of this, the company had been granted an exclusive 5-year license to manufacture and distribute the new vaccine. Although the license has no direct cost to the company, the directors believe obtaining a license is valuable asset which assures the guaranteed sales, and the value of the same is estimated to be 10 crores. KK Limited request you to suggest the accounting treatment of the above transaction under applicable Ind AS. You can read the problem once more. Before that, I just give one quick context and then you can read through once more. Ind AS 103 says all assets acquired should be valued at fair value basis. But how do you calculate the goodwill fair value? That they don't say it. Goodwill is always calculated as a difference between purchase consideration and net assets. Purchase consideration is the consideration paid, net asset, whatever is the fair value of net assets acquired. Now, in fair value of net asset acquired, it should be as much possible, or in the sense, all identifiable assets should be part of net identifiable asset acquired, so that the balancing figure can be called as goodwill. See, for example, everything cannot be identified. Building you can identify, data you can identify. When you acquire a company, you take over their workforce. Now, workforce, can you say the value of the workforce separately? No. There is many things, administrative process or many things which are part of the company's goodwill, but those cannot be recognized, assessed separately. So all those things will be subsumed, specified as, will be part of, implicit in goodwill. So wherever there is a opportunity, to the extent possible, an asset should be identified separately so that it will not be mixed with goodwill. Now here we have patents, we have then the manufacturing facilities having some license to produce goods, to manufacture and distribute new vaccine. So are these assets are separately identifiable? If yes, identify separately. If not, it will be part of goodwill implicitly. Hope you got the context. So read the problem. What you have to keep it in mind, is this an asset which can be recognized separately? If yes, at what value? This is what you need to keep it in mind. So read the problem once more. I will explain. Okay. Okay. So let me take up one by one. They said share exchange value 35 crores, net assets 15 crores. Okay. So broad calculation of goodwill, whatever is the purchase consideration or consideration paid, less fair value of net identifiable assets. Net identifiable assets. Okay. Purchase consideration, they said 35 crores rupees in crores. Net identifiable asset, they said net assets, other net assets 15 crores. Other net assets 15 crores. And we have does not include. And let's look at these three items. If these three items are separately identifiable, let's include it in the net identifiable assets. A patent owned by ABR Limited for an established successful intermediate drug that has a remaining life of 8 years. Consultant estimate the value of this patent to be 10 crores. However, the outcome of clinical trials for the same period are awaited. If successful, the value of drug would fetch estimated 15 crores. Now, current value is 10 crores. If successful, it becomes 15 crores. Now, if successful means that is a situation of contingency, right? We don't know whether it will be successful or not. So, let's not take that extra 5 crores that becomes a contingent assets. But what is to be recognized, separately identifiable, is this patent valued at 10 crores. So, you can say the patent for intermediate drug. Patent for intermediate drug 10 crores. And just keep it in mind, the 5 crores will be intangible. Sorry, not intangible, will be contingent because that is subject to the successfulness of completion of the product. If the clinical trials are successful. Okay. Second point, ABR Limited has developed and patented a new drug which has been approved for clinical use. The cost of developing the drug was 12 crores. Based on the early assessment, the value estimated the market value to be 20 crores. Okay, here is an interesting situation. First patent is 10 crores. I've taken 10 only, no? Other, see, we have other net assets of 15 crores and the first patent 10 crores. So, other net assets 15 crores, patent on 10 crores. Yes, that's what I've taken. Yes. Now, coming to second patent, that is an interesting situation. That is, you have developed at a cost of 12 crores and now it is fair value 20 crores. Which one you would have taken? Or which one take it now? Fair value. Because book value does not matter. At the time of acquisition, at the time of transfer of control, on the date of obtaining control, all the identifiable assets and liabilities should be valued at fair value basis. Therefore, fair value 20 crores. What if this was not a development drug? What if this was research expense? You know what they would have done? Research expense means they would not have capitalized as per Ind AS 38. Research expense would have been transferred to uh, P&L accounts. Now, in that situation, I'm discussing a different situation now, okay? Here, 20 crores, no doubt. But I'm discussing what if this drug was research stage and these expenses were treated as research expense and transferred to P&L account, and now the approval has been obtained. Can you take that in business combination? The answer is yes. But under regular transaction, you could not have done. Once transferred research expense, later approval obtained, you will not take it to balance sheet. You cannot capitalize under normal circumstances under Ind AS 38. But under Ind AS 103, this is a important point. Previously, how it is recognized does not matter. So previously, whether the asset was recognized or not does not matter. As on the date of obtaining control, is it satisfying the condition of an asset? Yes, recognize at fair value basis. I'll repeat the last sentence once more. Previously recognized assets and liabilities does not matter. It might be recognized or it might be unrecognized. As on the date of obtaining the control, is the asset satisfying the criteria? Yes, recognize at fair value. Anyway, that situation is not arising here because they clearly told it is cost of development and we don't go for the book value, fair value 20 crores. So fair value, so patent. The patent for new drug, clinical use, okay. So patent for new drug, 20 crores. Manufacturing facilities have been a favorable inspection by government and the company granted an exclusive 5-year license. License value again. For developing this license, you have not put any cost. So in your regular books, you will not do any cost. But as on the date of transfer, this license has a value, right? Hope you're able to understand. For this license, you may not have no cost. The license has no direct cost to the company. So it may be a no cost. So there is no recognition of asset. But that is not important. As on the date of transfer, is the license having the value of an asset? Yes. How much fair value? 10 crores. Recognize. So for the seller company, for the acquiree, it may not be a asset, but for the acquirer, it is an asset. So we go with the fair value 10 crores. License. And we will subtract any grant given. Government grant, I would have subtracted. No government grant, nothing to subtract. One question is there. If research expenses and still not approved, if it was research expense, still not approved, what is the point? As on the date of obtaining the control, is the definition of an asset satisfied? You're not got the approval means the asset criteria not satisfied as on this day. So it will not be an asset, so you will not recognize it. The question is very simple. The previous treatment does not matter. As on the date of approval, does it satisfy the criteria of an asset? As per any standard, as on the date of obtaining control. If yes, recognize this asset at fair value basis. Hope you got the point. Okay, so if I add all these fair value of net identifiable asset, 25, 10, 30, 45, 30, 40, 55. Okay, so if I subtract 55, I get negative. So it's not called as goodwill. Purchase consideration is less, so we call it as gain on bargain purchase. 20 crores. So, I mean, research expense is still not approved. You don't value it all. You don't value it cost. You don't value it all because it does not have any value, right? If it is not satisfying the definition of an asset, it cannot be added at cost. So your research expense not satisfying the condition, it will be transferred to P&L, not to balance sheet. So no question of valuing at cost. Okay, so hope you got this point. I'll go further. Okay, I think this is an examination question. Okay, good. Quite a big one. So as and when we read, let's write down what is happening. P Limited and S Limited are in the business of manufacturing garments. P Limited holds 30% shares of S Limited for last several years. P Limited obtains the control of S Limited. It acquires further 65% for the stake of S Limited. Earlier you were having 30, now you acquire 65%. So it's a case of multiple acquisition. 30 plus 65 resulting in a total holding of 95% on 31st December 2019. The following, the acquisition had the following features. Okay. With regard to the multiple acquisition, what point to be kept in mind? You are having some percentage, you acquired some percentage. Multiple acquisition or acquisition obtained in stages. Acquisition obtained in stages. So what to be kept in mind is when the control was obtained in the first acquisition or in the second acquisition, because treatment will vary in those two situations. If the control was obtained in the first situation and then the first date itself you will be doing a consolidation, and on the second date it will be accounted as an equity transaction. But if you obtain the control in the second transaction, the first transaction will be just accounted as investment. The second transaction where you start going to do the consolidation process. So which scenario will this fit into? You are having 30% earlier, which is reasonable to say other things remaining constant, you are not having control with 30%. 65% you got, that becomes 95. So we can say that you got the control in the second acquisition. You got the control in the second acquisition. So on the second acquisition, you are going to do the consolidation, recognize goodwill, if any. How will you recognize goodwill? Purchase consideration minus net assets fair value of net identifiable asset. But not only purchase consideration plus NCI, and purchase consideration will be of two kinds. One, currently acquiring 65%, previously having 30%. But what is the important point here? The previously having 30% existing equity interest, previously held equity interest should be revised, should be revalued at fair value. Difference should be recognized in income statement. Let's look at the numbers. P Limited transfers the cash of 50 lakh and issues 90,000 shares on the 1st March 2009. The market price of P Limited share on the date was 10 per share. Equity shares are issued as per this transaction will comprise of 5% of the post-acquisition capital of P Limited. P Limited agrees to pay additional consideration of 4 lakh if the cumulative profits of S Limited exceeds 4 lakh over next 2 years. At the acquisition date, it's not considered probable the extra consideration will be paid. The fair value of consideration is determined to be 2 lakh on the acquisition date. P Limited spent acquisition related cost 2 lakh. The fair value of NCI determined to be 5 lakh on the date of acquisition. Based on the market price, P Limited decide to measure non-controlling interest on fair value. P Limited has owned 30% share in S Limited for several years. That information we already know it. Yes, previous should be at fair value. Absolutely. It should be revalued and difference will be transferred to P&L. On 31st December 2009, the investment in P Limited in consolidated balance sheet is at 8 lakh. The fair value of this holding accounted for using equity method is valued at 18 lakh. The fair value of net identifiable assets on 31st December 2019 is 45 lakh, determined in accordance with Ind AS 103. Analyze the transaction and determine the accounting under acquisition method for business combination by P Limited. So you know the format. We'll write the quick format. This is only fair value method, so that is more easier. No proportionate method. So one will be consideration paid, then NCI at fair value because we follow fair value method. NCI at fair value minus net identifiable assets. Okay. Now, a few small points to be kept in mind. In the consideration paid, we are having two things. There are quite a few things. I'll leave some space. I write NCI at fair value at the beginning. I mean, a little below. Okay. Now, consideration paid, there are two things. First consideration and second consideration. First consideration is for 30%. Second consideration is for 65%. And the NCI will be 5%. That is how 100% valuation is being done. Now, this 30% acquisition, you had acquired at a cost. Don't go for the cost. You should go for today's fair value. So, first one will be fair value of previously held equity interest. Previously held equity interest. Fair value. Book value is 8 lakh, but fair value is 18 lakh. So, you should take it at 18 lakh. Basically, 8 lakh to 18 lakh, you have to recognize profit of 10 lakhs in your income statement. Revaluation of equity interest. Second, today, so whatever the 65%, whatever you are doing, quite a few things. You are having a cash, you're issuing the shares, and you are using additional consideration. So there is cash paid, and there is issue of shares, and there is additional consideration. But look at the additional consideration. Is it compulsory? If the accumulated profits of S limit exceeds 40 lakh over next 2 years, this is a contingent consideration, because if the cumulative profits exceed, in that situation you will be paying subject to conditions which is uncertain, may happen, may not happen in your terminology. And therefore this additional consideration, because uncertain, we will call it as contingent consideration. Contingent consideration. Okay. Contingent consideration should be valued? Yes. You don't want the certainty to take place. You will value the contingent consideration on fair value basis. Let's see what are the amounts. Cash paid 50 lakh. Issue of shares. You have issued 90,000 shares and valued 10 per shares. So 90,000 shares valued at 10 per share. 9 lakh. The fact that after acquisition they have 5% has no role here specifically. Okay, this fact that 5% has no role specifically, but the reason why they have given is it's only 5%. That's fine. But what if it is 65%, the shares issued? Then the issuer is not the acquirer, because other company is getting that control in your company, right? You are issuing the shares, 5% giving control, it's okay. But once you issue the shares after the acquisition, you become the minority, which means you are not acquiring the company, they are acquiring you. That is the case of reverse acquisition, reverse merger. The accounting acquirer is different from legal acquirer. Such kind of problem I've shared in the YouTube. Please watch it. There's one problem I institute. I've solved it already. Not come in the exam, but anyway, keep it in mind. Now that is for that purpose they're given the hint of this 5%. Otherwise, this is not relevant. NCI, contingent consideration fair value 5 lakh. NCI at fair value, sorry, contingent consideration not 5 lakh, 2 lakh. Contingent consideration 2 lakh. NCI fair value 5 lakh. And net identifiable assets 45 lakh. So if the compute the amount, if the resulting is a positive number, that becomes goodwill. Negative number becomes gain on bargain purchase. Think positive number you get. Yeah, think you get 39 lakhs. 39 lakhs is goodwill. And regarding this acquisition cost, as per Index 103, acquisition cost are expenses taken to P&L account, not to be affecting goodwill. So acquisition cost will be taken P&L, not to be affecting goodwill. Okay, hope you got it. I'll go further. Okay, next one. Bima Limited acquired 65% shares on 1st of June 2001 in NAFA Limited, which is engaged in the production of components of machinery. NAFA Limited has 1 lakh shares of equity shares of 10 each. The quoted market price of NAFA Limited was 12 per share. The fair value of net identifiable asset on 1st of June 80 lakhs. Bima Limited wired 50 lakh in cash and issued 50,000 shares as purchase consideration. The quote market price of Bima Limited was 25 per share. Bima Limited also agrees to pay additional consideration of 15 lakh if the cumulative profits earned by NAFA Limited exceeds 1 crore over next 3 years. On the date of acquisition, NAFA Limited assessed and determined that it is considerable probable that extra consideration will be paid. The fair value of this consideration at the date of acquisition is 9,80,000. NAFA Limited incurred 1,15,000 in respect to the acquisition. It measures non-controlling interest fair value. How will the acquisition of NAFA Limited be accounted by BMA Limited under Ind AS 103? Prepare detailed working notes and pass necessary journal entry. Not a difficult one, a straightforward one. So let's write the format, then we'll do the journal entry. Fair value method of recognizing goodwill and NCI. So first you will have a purchase consideration or consideration paid or payable, both will consider. Then we will be valuing NCI. We will be adding fair value of NCI. Then we subtract fair value of net identifiable assets. Okay, now consideration paid or payable will have quite a few things. If you will, when you pay cash paid. When you have issue of shares issued, fair value of shares issued. And if you have a contingent consideration, you will have a fair value of contingent consideration. And if you're having a acquisition in stages, multiple acquisition, then you will have fair value of previously held equity. That also will be there. So you have acquired 65%. Okay, so consideration is for 65%. Then the fair value of NCI will be for 35%. And of course, 100% will be the fair value of net identifiable assets. You wired 50 lakh in cash. Okay, so cash paid 50 lakhs and issued 50,000 shares and issue price 25. So 50,000 shares, 25. 12 lakh 50,000. Contingent consideration, fair value will take it. They have to pay 15 lakh, but fair value is 9 lakh 80,000. Fair value 9 lakh 80,000. And this 1 lakh 50,000 you ignore. Acquisition cost, expense during acquisition cost will be taken in the P&L account and not to be affecting goodwill. It will not be capitalized. It will not be taken for goodwill calculation. What is spending? Okay, fair value of NCI. How much is the number of shares of NCI? 65% you have acquired out of 1 lakh shares. So balance 35%. So 1 lakh shares, you have acquired 65%. So balance 35%. So basically means 35,000 shares is belonging to the outsiders. And those shares will be valued based on their shares. What is their market price? The core market price of NAFTA Limited is rupees 12 rupees. So into 12. So please understand, both the fair value we are considering, issue price, both the company's market price we are considering. When it is with respect to issue price, for this fair value of shares issued for purchase consideration, we have taken the market price of acquirer. Please be very careful in this point. Both the company market price will be given. Many people are confused between which market price to use. For consideration paid or payable, for purchase consideration, use market price of acquirer. But when you're valuing the NCI, fair value, if they're not given specifically, then you take market price of acquiree or target company. Market price of acquiree. So 1 lakh shares into 35% means 35,000 into 12, 4 lakh 20,000. Fair value of net identifiable assets, 80 lakhs. Subtract. If positive comes, goodwill. Negative comes, gain on bargain purchase. So you can say gain on bargain purchase, or you can say capital reserve. That's also fine. The negative number you get. You get negative number 3,50,000. So gain on bargain purchase 3,50,000. So take down this, then I will pass the journal entry. Okay. Journal entry, straightforward. This working note only will become a journal entry. So when you acquire an assets, whatever net identifiable assets, net identifiable assets. If goodwill comes, goodwill will be debit. To cash, to NCI, to shares issued. We say to share capital, to equity share capital, but issued at premium, to security premium, and contingent consideration is also there. So we tell to consideration payable, contingent consideration payable, contingent consideration payable, and because we got gain on bargain purchase or capital reserve also you can say, that also you create it to gain on bargain purchase. Okay, so net identifiable asset is 80 lakhs, cash paid 5 lakhs, NCI fair value 4,20,000. Then shares issued 5,000, 50,000. And what is the face value? NAFA Limited they have given, but what is Bima Limited's not given. Uh, we'll take it as 10 rupees. We'll assume it. Assume. Okay. So 50,000 into 10. Assumed. 5 lakh. And the market price is 25. So balance 15 rupees becomes premium. So 50,000 into 15. 7 lakh 50,000. That's what? Total 12 lakh 50,000. Contingent consideration fair value 9 lakh 80,000. Gain on bargain purchase 3 lakh 50,000. I hope total tallies. This is 50 lakh. Okay, I missed 1 0. Yes, that is total of 80 lakhs. Okay, hope you got it. Good. Okay. Uh, there is one more set of problems on that is net that step acquisition or acquisition of assets versus acquisition of business. There is some filter calculation are given. There is some criteria given. On that also some problems are there. I think I forgot to include in this material, but I have solved the theory question already. So what I will do, I will share the video of that Index 103 update on this business definition of business that change. Next year, consideration amount it has to increase debit to P&L. Yes, that depends on whether it is equity or debt. If it is in the nature of debt, yes, in this case it is the nature of debt because amount payable, the fair value change will go to P&L account. Yes, in this case, fair value change will go to P&L next year, whatever the change, plus or minus. Okay. So with respect to the business combination, I was telling the new definition has come in regarding the business, and some filter, some test has to be applied, some 10% test has to be applied regarding whether it is acquisition of assets or acquisition of business. For that theory, I've already uploaded. I'll share the video. Please watch it today. And problems, I'll do it tomorrow. Those problems I'll take from study material itself. So please have the study material tomorrow with you. About first 10 problems or something like that, which is depending on these questions. Okay, so I'll share the video on the theoretical aspects of the amendment. Please watch it. Tomorrow when we meet, same time 7 o'clock, I will be doing the problems on that particular amendment. If you have read the theory already and watched that video, solving the problems will become easier. Those problems are not there in this material, but they will be part of your study material about first 10 questions. I hope things are clear. So we'll see you tomorrow at 7 o'clock. Before that, please make sure you watch the video I share in the Telegram channel. So till then, take care. Bye bye. See you.